come to another very interesting subject, which is discounted payback period. And it seemed to be fairly easy, but as well having quite a number of disadvantages because of this relative easiness, but at the same time, again, having quite a number of positive sides, because in many situations, specifically smaller, simpler, it's a quite useful tool. Let us remember how it worked, so we'll refresh our minds from the first hour with this example of a small company that buys a machine. And please write down this into this nice table, as you remember from the payback. Then we have like one column is the year, then the next column would be the cash flow, and then the next column would be the cumulative cash flow. So at the beginning we have this year 0 when we have minus 100,000 for the machine, and then we have 5 years that we use this. Please write it down. And then this machine goes to 0. So we just use it like 5 years. But we have to decide on the project, and we expect that it will generate cash gains as follows. Like year number 1, 55,000, year number 2, 45,000, year 3, 25,000, year 4, 30,000, and year 5, 25,000. So if I use my hand as well, sort of to mimic this, to be sure that you have time to write it down. And we will use this payback period method to evaluate this project. Our bosses have the cutoff point of 3 years for all projects, so this one as well. So please now, having written 2 columns, please now write the third column when we have the cumulative. So please calculate it quite efficiently. I hope you will do it. Sort of cumulative for the year 1 is that, for year 2 is that, for year 3 is that, year 4, and year 5. Hopefully you arrive to the same table as I will show you in a moment, and it looks like this. You must admit it was sort of tricky, and it should be very fast. If it happens during exam, sort of less than a minute should be sufficient for that, because the project pays back in 2 years. 55 plus 45 straight. You could, on the first glance, you see that is 100, so it pays back in 2 years. So if the management tells us that this project has to be paid back in less than 3 years, obviously we accept this project. So this was like refreshing our minds. Now we go a next step further, because what would happen if we have more than one investment option? What would happen? So let's look at this table. Please write it down in a way that between the column project 1 and project 2 there is a space for cumulative project 1, and then after project 2 you have some space for a column like cumulative project 2. This is important, but you already know it. You are bright, so you know it, that we have to do it in this procedure. So we have these 2 projects, and we have to evaluate the payback period for them, for both of these projects. And then we know that the company cutoff is 3 years. Therefore, then we will compare it with 3 years. So please write it down, and now I hope you could calculate the cumulative, because then you would write like first year, obviously there's no cumulative, I mean in a 0 is no cumulative, first is 30, and so on. You add up, you add up, you add up, you add up. Project 1, I hope you have done it, it's just straight mathematics, arithmetics, it's adding up. And then the project 2, like 50, you add up, 75, you add up 15, you add up, you add up, you add up. I hope you have done it, hopefully. So your table should look like this. I hope it looks like, because we just make this cumulative. If we want further explanation, yes, we have further explanation, sort of very, very clear, that the initial cost is 100, and after first 2 years, this inflow is about, it's a 70, so it still rests 30. So then it's covered somewhere in the year 3. It's because in the year 3 the 50 comes, so it makes this cumulative 120. So it's over the project, so it's like somewhere in the year 3. But if we use the same principle for project 2 and we have this cumulative, then we could see that it is somewhere in this year, in the year 2. So when we look at this, we could see that both of them are below the year 3, so both fill up the requirement. But then there is a question how to calculate this more exactly. So we know that in project 1 it's somewhere between 2 and 3, but to find the exact, almost exact in this procedure time, we take this from the year 2 cumulative 30 and we divide it by this year 3 flow of 50. So what is missing we divide by what will come, and it gives 0.6. So in case of project 1, this will be added to full years of 2 plus 0.6, so it's 2.6. Yeah, 2.6. The same procedure happens in project 2 because it's somewhere in the second year, but in order to find where, we take the cumulative 50 from cumulative of the first year, we divide it by the flow in the year 2, which is 75, and we divide 50 by 75, so we have 0.67. So we add it up to the full year 1, and we have that in the project 2, the exact payback period is 1.67. In both cases, it is less than 3. So they might be both accepted. But because they are exclusive, so we do either this one or this one, we have to think about the decision. Both of them are below the cutoff point, but they are mutually exclusive. So based on this rule, we take this one that has the shortest payback period, that pays back faster. This is the only thing that interests us, how fast it will pay back. We just do not care what will happen later. We could see there are different flows, but we just don't care. We just are concentrated on this which comes faster. So when we have two exclusive projects and they are both under the cutoff period, we take this one which is faster. All right, so this is like a bit of a refreshing mind with the payback period. But now we have this discounted payback period. So the definition is the length of time required for an investment present value of future cash flow to equal its initial cost. The method is the same as in the previous one, but what we do, we discount these flows. You remember, this was one of the biggest critiques of the payback, that it does not consider time value of money, that it treats flows from every year the same. And we know from the time value of money that it should not be. So the solution is to discount payback. I will show you a very nice example. Please copy this if you could. Specifically take the attention on discount factor column. So please do it. And I will explain what it all means. That we are in hotel. We have hotel and spa. And we consider to build a new facility. And this project would cost us £300,000. And obviously, we do it, we invest it with a hope to gain much more money in the future. So, this project is going to generate cash flows over 6 years. And that's what interests us. So, in the year 1, 150,000, in year 2, 120,000, year 3, 80,000, year 4, 40,000, year 5, 30,000, year 6, 20,000. So our task is evaluate the project using the discounted payback period method. The company uses a cutoff point of 4 years. And this cost of capital, which means interest rate, is 10% per annum. So how we deal with this task? We construct this table when we have this, like in a payback method. So we have the year and then we have the flows. We leave the cumulative at the very end because we have to squeeze two more columns, because this net cash flow, as it is in this example, we have this in thousands. And then we have this discount factor. We remember this discount factor, I hope, already. So this 1 plus r to the n. So obviously in year 0 it's 1 because there is no time. But then when we come to the next year, this discount factor is 1 divided by 1 plus r to n. So it comes down to the next year, 0.90. You have these discount factors. So now we have to calculate the sort of present values of that. So we discount the net flow in this year by the discount factor. Obviously, minus 300 divided by 1 will be still 300, but 150 divided by 0.909 comes to 136.36. And in this way, we construct another column with the flows that are already discounted. So this 120 becomes 99.17. This 100 in the year 3 becomes 75.13. As you could see, further in time, sort of less it is worth today. No wonder. So present values are as such. And then we have the cumulatives, much the same as in the normal payback period. And obviously, when we add up, we could see that it becomes positive in the year 3. So, as such, it means that we are below the cutoff point of 4 years. So, yes, we accept the project. I think you grasp easily the concept. So, we make another example. Now, you will calculate. So, please write it down carefully. Example of comparison. Discounted payback versus payback. So, the investment is 500. The expected net returns are 200 each during 4 years. We have 4 years by 200. Then our policy is to cut off period of 3 years. The question is, would be this project accepted under the rule of straight payback? And is this project accepted under the rule of discounted payback? And discount rate is 10%. So please write down the key numbers. Investment 500 and returns during 4 years, every year 200. And then the policy is 3, rate is 10%. I hope you have written. So what is the procedure? I will tell you the procedure and you please write down the table and count. So, firstly you have to count the number of years of straight payback. Step 2 is to compare the answer with the cutoff period and provide the answer. Is it okay under the straight payback? And step 3 would be discount the yearly flows by the discount rate. Then count the number of years of discounted payback and then compare the answer with the cut-off period. And then we provide the answer. We are sort of running late suddenly, but I wanted to be very, very, very exact with you in explaining this. So you might stop looking at the PDF file and at the lecture later, but how it should look like, you could try to recopy this, because it should look like this, that payback straight happens in 2.5 years and discounted payback happens at 3 years 02. You will have this table. Hopefully you arrive to the same table yourself, because you have to analyze this table. You might try to copy it now, or you might take it from the lectures. It looks like this. I have as well a very clear explanation of counting this exact number, because now in discounted payback this is slight difference. This sort of -3 we will not divide by 137 but by 134, because it's discounted. So the explanation is on this page, how to calculate it exactly, but we know. So we come to our result that if the rule of straight payback, just normal payback, is used, project will be accepted because the return happens in 2.5 years, which is less than desired 3 years of cutoff period. But if the discounted payback is used, the project will be rejected because the return happens in 3.02 years, which is more than desired 3 years of cut-off period. To summarize that, we have the advantages that finally this payback includes, discounted payback includes time value of money. It's straight, easy to understand. Then does not accept negative estimated NPV investments. However, it's again an expression from accountancy rather, or high finance, bias towards liquidity. But disadvantages, we will find it later, that it may reject positive NPV investments, requires an arbitrary cutoff point, ignores cash flows beyond the cutoff rate, and it's biased against long-term projects when, like research and development. But generally, it has all the advantages and disadvantages of payback, but just crosses out one disadvantage of straight payback. It includes the concept of time value of money.